Hi, guys, and welcome to the 30th episode of the weekly trading wrap up, WTW, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Um, as usual, we're looking at a picture, a chart of the S&P 500. This is the week of June 9th and ends Friday the 13th. Lucky number. So here we have the week of the 9th. We have Monday, Tuesday, Wednesday, Thursday, and a down day on Friday because apparently World War III is going to start very soon and mark it down a bit. But regardless, this week is basically consolidation week, I would say, continuing the up pattern. So let's get started with our first analysis is always the technical picture of the S&P 500. So first of all, we will look at some moving averages. As usual, the most important is the 200. As we said before, it was flatlining as the market was tanking, but now that it's going and approaching the highs, it's starting to have an upward slope, which is very positive. Okay, we broke past it with a gap up day, retested, hit the 200, and back at highs. Okay, this could only be described as a very bullish pattern, and even apparently Israel striking Iran wasn't enough to destroy this upward pattern. So the market thinks this event that happened today on Friday is not that bad as of right now. Of course, it could escalate, but as of right now, they think it's nothing. So the technical picture right now is clearly bullish. And the sentiment we see, like the fear and greed index, is greed still. So people are still bullish, but not that extreme. And the AAII came out and showed a more normal picture for this week. The bearish sentiment is still it's still more than the normal than the historical average, which is this line here, but it's basically in line with historical average readings. Okay. However, this is just 1 week, and this, hasn't been cemented yet. We haven't cemented a bullish attitude yet. So this is why I think that any pullback, and I do have some short exposure because we're getting into very rarefied air here, and the market can pull back. I don't think the pullback is going to be that severe. We might retest here. We might cover this gap. My predictions, as you know, is that the first scenario that I think is going to happen is a narrow, let's say a narrow sideways choppy pattern going into the summer, because the summer hasn't even started. I guess it starts after the 4th of July. We have like 2-3 months left. So will this bullish pattern continue? I don't know. We'll see. But I still have a base case of like choppiness for the next couple of months. The second most likely scenario is the bullish one, which as defined right now we are in. That could break to new highs, and I said the most likely outcome or catalyst for that would be falling inflation, which we will get to in the macro section. So falling inflation will cause Fed expectations of rate cuts to increase. Lower interest rates means very bullish market. Okay, so that would be my catalyst for the bullish market into new highs. Okay? And the least most likely scenario is a bear market back to these lows, which I don't see happening. Tariff inflation was overblown. In fact, tariffs could be deflationary. And all the dangers, including World War III, don't seem to affect this market. So we are, technically speaking, still in a very, very bullish trend. Okay. Now let's get to our macro. Let's erase these lines and make it clean. So we had a couple of interesting things this week. On Wednesday, we got the core CPI, which is very important. it helps with our bullish case if it's low, and boom. United States core CPI came in at 0.1%. They were expecting 0.2%, so lower than expected. Okay, and at the same time, the next day we had PPI, Producer Price Index, and that came in at 0.1% as well. The core PPI, they were expecting 0.3%. So both inflation measures are very muted, very low, and support the bullish case. We also had one more piece of information on Thursday, which we always look at, is the continuing claims. And that, last week we had 248,000. This week we have the same thing, 248,000. Now this we should be taking a look at, because every time it spiked higher, it immediately went lower. Spiked higher. Now the spike higher is followed by a sustained spike higher. Not higher, but equal magnitude. So this means we should be taking a look at it, because it hasn't immediately gone down, and it looks like people are starting to file for unemployment. It's not going to happen right away. We have to see. This could happen over months, but we should keep an eye on it. So those, I'm not even going to mention the University of Michigan inflation survey. I'm just, these people are just stupid. They think inflation is going to be crazy, 5%, whatever, 8, 9, 10% for the year. It's just crazy. So I'm not even going to look at it anymore. It's just, I don't like when politics taints raw numbers, okay? We shouldn't have politics. People hating Trump and thinking that he's going to cause massive inflation is not a way to trade, okay? You shouldn't put politics into your trading. You should take it out. Excuse me. So this is for initial claims. We should take a look at it. It's very important for the future. Nothing crazy yet, just keep an eye out. Now, the big news this week was a war started in the Middle East. War because Iran was attacked by airstrikes from Israel, and they retaliated. Will it be a one-off? Will it be more? We don't know. But the market seems to think it's not a big deal. Okay? But there are some things that got affected by this move, and I like to call that the war trade. Okay? The three things of the war trade are gold, oil, and I'll mention silver too. But first, let's get into gold. As you can see, gold for the week ripped. It went from 3,300 to 3,430. That's a big move for gold. As you can see, as the market was in the highs, gold barely corrected. It stayed very, very high, very, very tight for gold. This is a very good consolidation pattern. And now that the market went down just a bit, we have gold trading back at highs. Okay, so to me, this is the perfect storm market for gold. Okay, because when the market goes up, gold remains high and doesn't go down. It's not risk off. Like you don't have a risk on trade where the markets are up and gold gets sold. Gold still gets bought and accumulated because we know that fundamentally speaking, things have changed. There is a fundamental driver behind this, and that is China and other foreign central banks buying it for geopolitical and, let's say, currency-related, economic-related reasons, okay, that are fundamental and long-lasting. So you have a case here where gold stays relatively high when market goes up, and you see market just dips a bit and gold rips. So this is almost like a win-win scenario for gold. Small loss when it goes up and still being accumulated, and big win when the market just slightly goes down. So the war trade, like gold is really benefiting from market uncertainty, if you will. You can call it the war trade, but it's market uncertainty, and gold loves uncertainty. Okay. The other thing that does well in the war trade is oil. Okay, U.S. oil. As you can see, generally in a downtrend, I don't like oil. Generally speaking, I'm bearish, and the fundamentals speak to that. However, when you have geopolitical risk and a threat of a war coming, you can't control that. So gold rips, still relative. I mean, you saw the price go from 68 to as high as 77 and settled at 72.91. This is West Texas intermediary crude oil. West Texas Intermediate, I think it, or Intermediate. I don't know, WTI. Crude oil spikes. So it hasn't yet, I mean, it looks like a big move, but it still hasn't yet broken the technical down picture, okay? It has here, it recaptured that level, that huge breakdown level here that goes back for a long time, okay? It has recaptured that. But is it just a one-off? Like if this Iran-Israel war turns out to be just a one-off and people just throwing missiles at each other and they say, okay, we both satisfied our egos, we both save face, then yes, this is going to go back down. But if it's protracted, if it stays for a month or two or whatever, then oil is going to stay high and rip. And that's not going to be good for our inflation trade, okay? Because we saw that with inflation going down, that's good for future Fed rate cuts, okay? So the oil trade now is, I mean, I'm short here, so I'm losing it, but I have puts, so it's okay. My loss is defined. But I still don't think, unless the war is sustained, I still think that oil will head back down. That's only if it's just fear-based and a quick retaliation between the two forces. Okay, so this changes if it comes back down here and then starts rising again. Then I have to revisit. I'm clearly wrong, and oil is going to go back up. Okay, and if that happens, you're going to have a lot of damage to the economy. Like SPY might not be here. I mean, with high oil and high inflation, interest rates are going to stay high, and the Fed Watch tool, the expectations for lower interest rates or more cuts is going to go out the window. Okay, so let's look at the Fed Watch tool here. You can see, like, for the next meeting in June, which is coming up next week, 100% chance that nothing's going to happen. But let's see, for the whole year, there is a 40% chance of 2 cuts. Okay, 3.75 to 4. Now we have 4.25. So that's 2 cuts. This increased, okay, because of the war. Excuse me, because of inflation, not because of the war, but because of inflation being so low, the odds of 2 cuts went from like 34 or something to 40. So the market is still seeing a high chance that inflation will continue to go down, and that this war and oil move is temporary. That's what the market is saying right now. Because look, SPY barely moved, barely broke didn't even break the uptrend. Okay, so SPY is down just 1% on this war news. I don't know. That's why I think this oil thing might be temporary, because if the market, like we said, if it's just a tit for tat, to save face, throw missiles my way, you throw missiles, I expect missiles from you, and then it's over, then oil is going to head right back down. Of this, I am certain. Okay, and the other thing that piqued my interest is this week is silver. Silver, despite all of that, maintains the highs. We said that the breakout was coming when we got, we got long here, and we were certain. We were seeing underlying shifts into the silver space here, especially my silver juniors. I mean, they were going up before the price of silver, and then silver ripped, broke out, and we were expecting what might happen today. What happened in the past would happen today, in that every silver spike gets sold off hard. Okay, and we didn't see that now. And I mean immediately, like in a day. The next day after a spike, it would go down. You would see like boop boop, railroad tracks, as we call it. Big up day, big down day, giving up the entire big up day, and then months of decline. Here we don't have that. We have the breakout and holding for this week. Okay, so this is a big deal for me, because we have 1 week of the breakout holding. If we have a couple more, maybe a retest and go back up, this is very, very bullish for silver. Very bullish. In fact, when we have a war premium with gold and oil going up during some kind of geopolitical risk, silver gets smoked. It gets killed along with the market. It's levered to the market. It is positively correlated and levered to the market. So I would have expected silver to get tanked today, destroyed. Instead, nothing. Flat, indecision type candle. This is beautiful. This is exactly what you want to see if you're a silver bull. Okay, and I even see it in my equities that I'm holding, that they are up big and holding their gains. Okay, so this is very, very positive on the silver front. I like this action. I'm looking forward to more on this. And the last thing that I want to mention today is GDX relative to SPY. Okay, this is the GDX, which is the gold miners over SPY. Okay, if they are outperforming, which this is the beginning of 2005 right here, they've been outperforming the metal. The miners, the gold miners have been outperforming general equities, if you will, the S&P 500. Okay, they gave it up a bit, but now it's back up to like close to where it was before. Okay, what you want to see as I've been touting gold, and we've been saying that the miners have sort of lagged the move, given that it is an all-time highs and holding above 3,000 and going in a perfect storm. The miners are not in a perfect storm. As you can see from the past, okay, what we want to see is a move that happened maybe like in 2020, but I like the 2016. This is a chart that I've shared in my Twitter, but I'm like exploring it more, blowing it up more in my right here in this presentation. So we are here, okay? We made this move. We went from, let's say, 0.057 to 0.09. So it looks like a big move, and it is in a short period of time. But what you want to see is this move right here, okay? In 2016, we went from 0.06 to like more than doubled 0.14, okay? Which serves as the benchmark for this level here that I'm expecting it to go to, okay? Which is maybe another 2 times here. This is a big move. I remember 2016. This is when Janet Yellen went from 0 interest rates and increased rates by 25 basis points, and the market tanked. Okay, and like literally January, she reversed course. Like a month later, she reversed course and said, we're going to go, or she was thinking of raising rates, and the market freaked out. And then she goes a month later in January of 2016, nope, I'm not going to raise rates. And for months, up until August, June, July, August, gold miners were on a tear. Okay, on a tear. Continuous, very little pullback. Okay. This is what I'm expecting to see here, especially since the fundamentals are way better than they were in 2016. Okay, but I mean, this is good. But what you really want to see is this move right here, where it outperforms, where gold outperforms the S&P 500. This is the 2011 highs by a wide margin. Okay, here, the relative ratio between the miners and S&P 500 right now is at 0.09. Okay, let's call it 0.10 to be generous. Okay, and it went as high in 2011, 0.55. So literally 5 to 6 times the current state times. So if some miners went up double, they're going to be up, what is it, 20x, 100%, 100% times 5 to 600% more. And I'm talking about relative to the S&P 500. So if the S&P 500 goes up, this would go up even more. Okay, so this is what I don't know if I'm expecting this. You really need a shift, a mind shift, which could happen. I think over time we will get a mind shift where gold miners will start taking a massive bid, because this state of events right now is stupid. It's crazy. I mean, it shouldn't be this cheap given $3,300 gold. I mean, the margins are so huge for gold miners. They're printing money. I'm going to say even more money than they printed here. The gold mining stocks were acting stupidly. They took on a lot of debt. They tried to expand with stupid projects that didn't have positive NPV, or The NPV was positive only at a ridiculously high gold price over a 10-year period. It's just stupid. But here, pristine balance sheets, huge margins, highest free cash flow yield of any sector in the industry. This is still, after a big move, it's still dirt cheap. We are in early innings. So I think right now the big move is in gold miners. So let's recap. This market, bullish, super strong. Okay, even potential World War III event wasn't enough to kill it. Still very, very strong. I expect a choppy market though going forward. Any significant dip, I think, will be bought. We're not going to crash just yet because nothing is really tanked yet. And I think that the most undervalued, I'm still very light on general equities here, but I think the most undervalued sector right now is the gold and silver, let's call it the precious metals miners. So that's it, and looking forward to next week. Let's see what happens.